Okay, so here we go. Another one of these problems where we're going to do three things, record a note, record accrued interest, and then pay off the note. And this is another one of these test track questions. Okay, so ABC borrowed $38,000 on September the 1st, year one, from Valley Bank. ABC agreed to pay interest annually at a rate of 9%. The note issued by ABC carried an 18-month term. So this is an 18-month note. And based on this information, the amount of interest expense appearing on ABC's year one income statement would be what? Okay, so the first thing we're going to do is we're going to show that we've got $38,000 here, 9% for 4 months. That's going to be the interest we're going to show for the months of September, October, November, and December. Those 4 months would be 4/12, 9%, $38,000. And so the amount of interest expense we're going to show on year one right there at the end of 12/31, year one, will be $1,140. That's the answer to that. Okay, the fact that it's an 18-month note does not affect the 1-year interest expense, right? And so we're on to the next problem. Next problem, ABC issued an interest-bearing note payable with a face amount of $25,200 and stated interest rate of 8% to the Metropolitan Bank on August the 1st, year one. The note carried a 1-year term. The amount of cash flow from operating activities on year one statement of cash flows would be what? Now, this is trying to get to you understand. It tries to test your understanding of, do you know what an operating activity is, and do you know if it's cash outflow, cash inflow, and so forth and so on. And does this situation up here, is this something that's going to be connected up to an operating activity? Is that what it is? So anyway, so here's our accounting equation. Here's cash, notes payable, 25,000. Oh, I have a typo here. This should be 25.2. So I hope that you'll forgive my typo right here. Maybe it isn't a typo. I don't know. We'll see in just a second. 25.2 is with the amount of the principal on the note. And let's see here. Okay, I had just two typos. That's what it is. It should be 25.2. When you borrow the money, you increase cash by 25.2, not 25.5, and you increase liabilities under notes payable by 25.2, not 25.5. That was just my error. Okay, so the 25.2 borrowed is classified as a financing activity. And anything else here? Not an operating activity. So when you borrow money, that's something that on the cash flow statement is going to be in a financing activity. It's not an operating activity. So the amount of cash flow from operating activities for year one is nothing. It doesn't apply because this is a financing activity. So that's trying to test your knowledge of what a financing versus operating activities are. And so no interest is paid on year one. So therefore no cash flow related to the interest. So this was financing activity, and there was no cash flow related to interest. So that's the interest. That's the answer we're looking for here. Okay, let's go to the next one. ABC Company issued a note, an interest-bearing note payable with a face amount of $8,400 and a stated interest rate of 8% to Metropolitan Bank on August the 1st, year one. The note carried a 1-year term. Based on this information alone, the amount of total liabilities appearing on the ABC's year one balance sheet, which is right here, right there, would show what? So what we're going to basically be carrying is we're going to show for total liabilities, we're going to show the principal and the interest that we've accrued from the time the note was written, which is August the 1st until December 31st. So those two things are going to be the total liability, the principal and the interest. So total liability for the note is going to be principal plus interest as of 12/31 year one, which is right there. So determine the interest on the note. We're going to take $8,400 times 8%, which is what the interest rate was up here, 8%, times 5/12, because 1, 2, 3, 4, 5. There's 5 months have gone by there, so 5/12. So the interest portion is at $280. And so the total liability will be the principal portion, which is $8,400, plus the interest portion, which is $280. So the total liability, or the answer for this question, is $8,680. Total liability, principal and interest. Questions about that before we go to the next one? Well, let's go to the next one. Let's see, and then now before we go to the next one, I think I showed in here how this would be shown on the accounting equation. So you would do on the account. This is not, you don't have to show this, but I showed it anyway. You'd have cash coming in of $8,400 and also an increase to notes payable for $8,400, and then when the interest was accrued at the end of the year, you would show interest payable and interest expense. 280 would go up, the liability would go up 280, and interest expense under equity would be a minus 280 because, you know, the liability goes up, then equity is going to go down. So both sides are going to basically stay the same here. And that's how you'd show that on the accounting equation. But all you really had to show was just make this calculation down here. Okay, so let's take a look at the next one. ABC Company borrowed $28,000 on April the 1st of year 1 from BB&T Bank. Hey, that's a good bank, right? The note, it's not as good as US Bank, but it's not a bad bank. The note issued by ABC carried a 1-year term and a 6% annual interest rate. ABC earned cash revenue of $940 in year 1, and they earned $900 in year 2. Now they're telling us that we've earned revenue in these 2 years for a reason, because they want you to assume no other transactions, and they want to know what the amount of net income would be for year 2's income statement. Well, we only have revenue. We only got 2 pieces of revenue here, 940, 900, year 1 and year 2, and we only got 1 expense, and the 1 expense is this interest expense. So let's make our calculations and come up with some kind of a net income. So revenue minus interest expense, and it's going to only be for year 2. So this is how much interest we would have accrued for this note in year 1. 28,000 times 6% times 9/12. That is, there's 9 months from April the 1st to December 31st. There's 9 months involved there. Times, like I said, when you multiply all these things together, you get $1,260 worth of interest expense. Interest expense. And this is good to kind of give you the foundation of how the problem's going, but you don't really need this if you're going to just solve for this year 2. But it's good to know. In year 2, we had 3 months worth of interest, because remember, this is a 1-year note, and if it started on April the 1st of 1 year, it's going to end on March the 31st of year 2. So that's a total of 12 months. Keep that in mind. 9 months in year 1, 3 months in year 2. So all we really care about is what happened in year 2, because we're trying to find year 2 income statement. So 28,000 times 6% times 3/12 is going to be $420 worth of interest expense. So to get a net income, you're going to take, there's our $420 interest expense calculation one more time. So to get an income statement, we're going to take revenue of $900 in year 2 and $420 worth of interest in year 2, and you're going to end up with a net income of $480 in year 2. They could have asked the question for year 1, right? And if they asked it in year 1, we'd have had revenue of $940, but interest expense of $1,260, so we'd have had a loss. In year 1, we'd have had a loss. In year 2, we have a net income of $480. But anyway, that's the answer we're looking for, $480 for this problem. Okay, now this is a classified balance sheet. A classified balance sheet is I'd say a better way to put together a balance sheet, because it shows you information in a time-related way. And it's hopefully more useful to most people to have it. I mean, it's more useful for me. I know if I were trying to put one together, I would always put together a classified balance sheet. And so a classified balance sheet basically deals with, you know, classifications like current assets. These are assets that are going to be used up within 1 year. And these are assets down here, property, plant, and equipment. They have a life of more than 1 year. So 1 year or less, more than 1 year. That's basically how you separate these things up. And in terms of assets, do the same thing for liabilities. These current liabilities are liabilities that are going to be due within 1 year, due and payable within 1 year. And then you have long-term liabilities that are more than a year. So 1 year, more than a year. And that's the basic classifications. So 1 year or less life, 1 year or more life. Under liabilities, due in 1 year or less, due in more than 1 year. So that's really how you classify these things. Now, I said all that because here's the problem. The problem that we have here, the one for the test, is this is the one you're going to be doing for like you do all these little short answer, multiple choice kind of things. And then this is the problem. The problem is on exercise 7-22A. They want you to prepare, or I want you to prepare, a classified balance sheet. Okay. Now you can watch this, what I'm about to do. And you can also watch the hint, and whatever is more useful to you, then that's the one you should do, right? Or both of them, or whatever. But this will be the problem portion of your test right here, to putting together this classified balance sheet. Now I've already got it put together right here. It's already put together, but I'm going to show you how I did it, or how I would do it if I was doing this in the real world. I would, first of all, notice this. These accounts that you're going to go from here over to here, from this list over to this actual classified balance sheet, they're in alphabetical order. They're not in the order that you would normally put these things in a real world situation. In the real world, you classify things or put things in what's called liquidity order. Liquidity means that you're putting in the things that you're putting down first, the things that would be most liquid, that is, you could turn into cash most quickly, right? And so you have to pretend now that all these things are blank. Just pretend that for me. You got to pretend that all these pieces right here are blank. And so if I had a blank slate over here on this right side that was the classified balance sheet blanks, and I'm trying to fill in these pieces, in here, here's exactly how I would do it. You may do it differently, but I would do it this way. I would do it in liquidity order. So I would say, okay, starting at the top, the most liquid asset there is cash, of course, right? And so I would say, number one thing I would do is put down 15,290 in the cash column right there, 15,290. Then I would go to the next most liquid asset, which in this case would be accounts receivable. And I would take accounts receivable and I put it here next. And then again, going in liquidity order, I would go merchandise inventories next. And now I've got these three things, and I've got all the current assets listed. There's not any more current assets in this little pile of accounts here. I would take those three things, I would add them up, and I would come up with total current assets. That's the next step I would do, which is 4 right there. It's the fourth thing I would do. Then I would go down to the next least liquid asset things, which would be property, plant, and equipment. And I would say, okay, on this list right here, my next entry I'm going to make here is going to be under, let's see here, is going to be number 5, which is land. The only property, plant, and equipment I have is land. And I'm going to put it down right here, land. And then I'm going to carry it over here as the total, the subtotal for property, plant, and equipment, which is $18,000. And then the next thing I'm going to do is add these assets together, the short-term ones and the longer-term ones, add them together, come up with the total assets. So total assets now are 107,480. That's my 6th step in this process. Now I'm going to go to the other side of the accounting equation. I'm going to go to the liability equity side, and I'm going to start putting in things again in liquidity order, or in things in what's due. So current liabilities are due first, right? So the only current liability I've got is accounts payable. I'll put it down right over here, right over there, right? Accounts payable. And then I'll put down long-term notes payable. So we got long-term notes payable, and that's all my liabilities. So now I'm going to add these two liabilities together to come up with total liabilities, right? So that's going to be 9, step 9. And then I still got a couple things left over here. I need to move over to this blank sheet. And then the next thing I'll put in here would be common stock. So common stock is going to go over here, 41,500. And then the last thing will be retained earnings. I'll put that in. So now I can add these two together and come up with total stockholders' equity, right? And then I would take my last step and I would add the liabilities. Now we're looking at the accounting equation, right? I would take liabilities and add stockholders' equity, and I better come up with a number that's equal to these total assets. If I don't, I got a problem. And you would do that on your sheet too, on the one you're going to do from scratch. You're going to make sure that these total assets have to agree with, the other side of the equation. If they don't, then you go back and figure out what happened here. You go back and, check your math. Maybe you transposed a number, whatever, you put in something wrong there, whatever. But anyway, then that's it. And so, like I said, the final cross check would be to make sure that total assets on the left, right, equal to what's on the right, so liabilities plus stockholders' equity. And if they equal, you're all good.